Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things you need to know today.
First up, U.S. stock futures falling this morning after snapping 6 days of gains. Investors keeping close tabs on tax bill negotiations in Washington as lawmakers debate cuts at the center of the Trump administration's policy agenda. Rising bond yields also adding pressure to the stock market amid growing concerns about the fiscal deficit and mounting debt.
Plus, Target shares sinking this morning. The retailer cutting its outlook on the dual hit of a consumer slowdown and tariffs. The results calling into question whether CEO Brian Cornell can execute on plans to recapture growth after 2 years of choppy results. On a call with reporters this morning, Cornell expressed he is not satisfied with the latest earnings and says he has to drive traffic back into stores and the website.
And sticking with company news, Nvidia CEO Jensen Huang urging the U.S. to ease AI curbs on China after a, quote, failure of the restrictions to help contain China's growth in artificial intelligence. The CEO calling for policymakers to propel U.S. AI technology by lowering export barriers aimed at curtailing the rise of a geopolitical rival. Huang telling reporters at the Computex conference that China alone will account for a $50 billion opportunity in 2026.
U.S. stock futures sliding this morning after snapping 6 days of gains. Rising bond yields weighing on risk appetite as traders focus on risks in Washington with fiscal and deficit concerns mounting. Joining us now, we've got Yahoo Finance's Josh Schaefer here. Josh, some slippage here in the pre-market. What are a lot of the kind of street analysis and commentary tying this back?
Yeah, Brad, so you're starting to see a little bit of a pause in that 6-day rally that you mentioned, right? And really the rally that we've seen over the past month, I don't think you've seen much of a break really since probably April 9th, right, when we had that big move higher. Yep. And what strategists have pointed out at this point is you're now back to the S&P 500 being within 3% of a new record high, right? Like we have come essentially almost all the way back from that record high that we fell from in February. And so now you're starting to see some folks warn, okay, we've priced in a lot of good news here. So EY's chief economist, Greg Dacko, is saying equity markets have, quote, reacted with unwarranted optimism. Of course, Greg referring to the economy there and essentially saying, we still have the data that needs to come, right? So yes, I understand the tariff rate has come down from maybe an estimate of 24% to about 14% now. And maybe that's better for the recession calls that were out there. Maybe it's better for the overall economic growth story. But someone like Dacko at EY sees GDP hitting, increasing year over year in the fourth quarter at 0.6%. I mean, that's not a great number, right? And that's slowing economic growth. He sees inflation higher. So essentially saying the risks, if we're thinking upside or downside risks, the risks are probably still tilted to the downside. So that's perhaps where your concern should be. And then overall, if you think about what that means for the equity market, we might not see a resurgence in economic growth, right? I don't think that's the narrative right now. So at some point, has the rally perhaps gone, I don't know if it's too far or gone as far as it's going until we get some sort of confirmation from the data in the next couple months, realistically.
And Gina Martin-Adams with Bloomberg Intelligence citing the earnings estimates for the next quarter here as still too high based on all of those risks that you laid out, Josh. Where are investors seeking safety in this moment, given the volatility that we're seeing in the bond market, given those risks that you talk about?
Yeah, it's not in the bond market, right? It seems like investors are still seeing some flows into some of that overseas trade, right? But really what you've seen over the past 2 days is a little bit more of that sell America trade, as it's sort of been dubbed, when you've seen the dollar weakening, you've seen bond yields higher, you've seen a little bit of weight coming out of U.S. equities. But I was talking to one strategist yesterday who sort of pointed out, so this was Victor Hewer over at BNP Paribas, and he pointed out to me that really it makes sense that you would see the market take a breather at this point when you think about how quickly the market moved back up higher. So essentially, he was looking at sort of the technical side of this rally and said you had a lot of people just move instantly bearish on April 2nd. You had a lot of short covering come after that, gives you this large move higher on simply one catalyst, which was really just different things the president has been saying. Now you get to a point where the market is perhaps more equally valued. You have investors in more equal weightings, and then that puts you in a place where you can sort of go either way from here, again, depending on how those earnings and data turn out. But you're in more of a equal footing area, 3% from your record high, and now you're kind of waiting for more information. Again, maybe we get that with what we're starting to talk about more and more with Nvidia earnings next week. Maybe that's your catalyst.
Exactly. Maybe that's the catalyst, and maybe there's not any bad news that pulls people away from their Memorial Day vacations coming up.
I'm just trying to cook some burgers, guys.
You know?
It's Memorial Day.
Right, we want to be off too.
Brad wants to do a real barbecue. I can see it on his face.
Look, man, I thought you would have a ribeye set up. You already show us all of your spaghetti cookings every Sunday.
Right.
So.
We'll work on it, Brad.
We'll
All right,
work on
some chili maybe in the future.
Thank you, Josh. Appreciate it as always. Let's talk about Target. The stock moving firmly to the downside after missing first quarter estimates and cutting its full year sales outlook. The retailer hit by weak consumer spending, tariff uncertainty, and backlash against its DEI rollback. The stock down a little over 6%. Joining us now, Bill Kirk, Roth Capital Partners Senior Research Analyst. Bill, great to have you on this morning. I want to get your reaction to this print, the uncertainty that Target talked about in comparison to what we're hearing from other retailers. Do you think that the price action at the downside is justified based off of what we got out of this print?
Thanks for having me. And yes, simply put, I do think the price action is justified. You kind of led with compared to other retailers, and I think that's a great way to do it. If you contrast Target's results today to Walmart's last week, you see a stark difference. Target comparable store sales decelerated from plus 1.5 last quarter to minus 3.8 this quarter. Take Walmart. Walmart did 4.8 this quarter from 4.9 last quarter. So no change at Walmart on comparable store sales and a deceleration of 5 percentage points at Target. If you do profitability, Walmart earnings this quarter up year over year, slightly, but up. Target EPS, adjusted EPS, down 35% or so year over year. So I think when you contrast it against other retailers, in particular Walmart, the price action this morning is justified.
Walmart was talking about raising prices. Does Target need to do the same?
Target needs to, in the sense that input costs are going to be up for tariffs. They have a larger tariff exposure than even Walmart, but Target's in a trickier position because their assortment is a little bit more expensive and it may be priced too highly to begin with. So it's a little bit harder for them to go and raise prices when the consumer doesn't seem to love their price points to begin with, right? So they're in a trickier kind of in between a rock and a hard place where, yes, they will have to raise prices to offset input cost inflation, but consumers are already not thrilled with their price points today.
And it's interesting because given the uncertainty in the macro environment, Amy Wu Silverman telling me earlier this week, this is a moment where investors are betting on management versus companies overall. Is this a moment then where Brian Cornell's leadership comes into question?
He's managed a lot of different volatile periods. So he has experience in these difficult periods. But what I would say is, they keep talking about longer term. We feel great about the growth opportunities. We feel great about the profit opportunities, but they haven't grown over the last 4 years, right? They haven't basically grown since 2021, and profitability is about half of what it was. So maybe longer term it's out there, but I would consider 4 years part of the longer term, and they haven't had it materialize. They're in a tricky position where they need to catch up to Walmart, and that requires a lot of spending. And they don't quite have the ammunition available for spending. This goes back a few years, but in that 2021, 2022 period, they went and did 10 billion plus in share buybacks. The stock is down more than 50% since they did the 10 billion in buybacks. So they lost a lot of money on those share repurchases. But more importantly, that 10 billion would have been wonderful to invest behind the business back then on the technology initiatives, behind pricing. Invest some of that 10 billion 4 years ago behind pricing, and they would be in a much better spot today to compete than they are.
Bill, I was taking a look at a note from Apollo chief economist Torsten Slok this morning saying that up to 10% of households in May 2025 could face a steep decline in their credit score because of what we know has been coming for a while in this student loan repayment cliff, essentially. As you're thinking about that, does Target have a more outsized student loan repayment issue and problem on its hands, given its mix and the overall inventory it has?
I think yes, and I think you're right. It does come down to the mix. They just sell more discretionary product than a lot of the other retailers I cover, right? They sell more discretionary things you don't necessarily need. items. They sell more than Walmart. They obviously sell more than the pure food retailers like Kroger and Albertsons. So from a mixed perspective relative to those names, yes, they would have more exposure to any sort of tightening of the budget because those discretionary items are the first thing to go. They go before discretionary experiences. People don't like to cut travel and experience on the discretionary side, but they will cut discretionary physical, tangible items.
That's really good context then, Bill. It makes me wonder, let's say you had a career change and you went into consulting and Target brings you on staff. What is the data point that you are whispering in Brian Cornell's ear to really focus on to improve and turn around back to that growth story that you mentioned?
It would be you have to take the pain today of announcing a very large investment period. You have to tell Wall Street that earnings are going to be muted for a while, but we think if we put this money behind technology and we put this money behind price, we can get back to that long-term growth, right? They're promising long-term growth, but don't really have the actions to deliver it, right? The actions they talk about are kind of nebulous, right? They say things like, we're going to bring back the Target magic. That's fine, but I don't even quite know what that means, right? So my advice would be increase investment, physical investment on the capital side behind technology and behind price. Yes, that will mute earnings for a while and it would probably come with an earnings decline, but that's what needs to be done to deliver this longer term promise you keep offering.
I guess with that in mind, how long does it take from what you've studied in the past and what you've ultimately witnessed at other retailers when there is a more kind of consumption mindset shift and specifically thinking about the diversity, equity, inclusion, walk back and now the backlash that is taking place. At what point does that become a more permanent fixture in consumers' mindset?
I think we're evolving toward that, right? Like you have to ask yourself what makes Target unique? What can they do or what are they doing today that's different than other retailers? And I just feel like that list of what is unique is getting smaller. They still have some great partnerships, right? They have great partnerships with Ulta. They do great in the private label brands, particularly in apparel with things like Cat and Jack. So they do have some of those things, but that list of what is unique about Target keeps getting smaller. And then when you talk about what can Target do, like what are their capabilities, it narrows even further. If you look at like e-commerce, they're behind Walmart on e-commerce. Target's e-commerce business grew 5% year over year. Walmart's grew 22. Walmart's is an order of magnitude larger than Target's already, and it's outgrowing. The growth rate is 4 times higher. So they're very far behind, and I struggle with what makes them unique in this current environment. And that goes back to your point of consumers aren't compelled to use Target in the same way they once were. And that makes boycotting a lot easier. Regardless of who's doing the boycott, if you're not compelled to use Target for a particular reason, it makes a boycott far simpler to execute.
Bill, good to have you here with us this morning. Ahead of the market open here, we're going to continue to track shares of TGT. Thank you.
Thank you.
A tale of two retailers when looking at Walmart and Target. Target shares sinking after cutting its forecast and warning on the impact of tariffs. Meanwhile, its rival Walmart maintained its full-year outlook and expects sales to grow between 3% and 4%. Here with more on how Walmart pulled ahead of Target is Yahoo Finance senior reporter Brooke DePalma here. Brooke, what have you assessed?
Yeah, good morning to you both. This is certainly a tale of two very different retailers. We know that Target really struggled to find its footing, especially as it faced that backlash from the pullback of diversity, equity, inclusion initiatives. Meanwhile, Walmart continues to attract customers with their key grocery category. Let's break it down in 3 parts. Same-store sales growth, their guidance, and then also that product mix. Taking a closer look at same-store sales growth, what we heard from Target is that they reversed that same-store sales momentum that they saw with a decline of 3.8%, far different than what Walmart U.S. store saw with an increase in same-store sales growth. And as you can see here, this is really a trend that we've been seeing over the past, say, 2.5 years since inflation peaked in the second half of 2022 as consumers really focused on wanting low prices and value for their money. Now, what this has led to today is this guidance outlook that Target has set, essentially cutting their outlook for 2025. They now expect a low single-digit decline in sales. That's down from 1%. In the previous quarter, they had said, well, Walmart, they reiterated, albeit conservative guidance. They now project sales to increase between 3% to 4%. Why is this all happening? Walmart's product mix is winning. We know that for a fact. One analyst telling me that Walmart is better positioned for traffic consistency. What's bringing in traffic? Groceries. Walmart's business is made up of 60% groceries. They also have about 10% coming from health and wellness, and that remaining 30% is general merchandise. It's a far different story than what Target's offering here. We know that just 20% of what Target's offering is food, followed by 10% beauty, 15% essentials, 15% apparel, 20% home, and 20% hard goods. Like think toys, think baby strollers. And essentially those are the items that in this sort of environment, consumers are saying we could do without.
Well, Brooke, it makes me wonder too a little bit more about the pricing pressure of these companies. If product mix is such a concern, who can maybe win on price? What are we hearing from both Target and Walmart in terms of the tariff impact on their pricing power?
Yeah, just Thursday, Walmart came out their earnings and they made this big splash saying that they are going to have to raise prices because of tariffs. Of course, that was met with backlash over the weekend from President Trump. And now Target, not so quick to say that they're going to raise prices. In fact, they were very, they declined to say whether exactly they will have to raise prices. They did say that pricing is a very dynamic part of their business, that they're going to constantly have to adjust. They also said that they're looking to mitigate price changes by bringing, or rather sourcing more products from the U.S. Instead of China. But what we remember is that this time last year, Target made that huge splash that they were rolling back prices. We saw that reverse in same-store sales growth in the middle of the year. And now, at the end of last year, they said that 10,000 goods they were able to lower prices on. Because of these tariffs, the reality is it's going to hit retailers' margins if they don't, in fact, use mitigation strategies, one of them being higher prices.
Yeah, and that's certainly something that we heard from Bill Kirk as well. Brooke, thank you so much for bringing us your reporting. Really appreciate you breaking down the differences and similarities between those retailers. Coming up here on the Morning Brief, we'll count you down to the opening bell on Wall Street. Plus, Nvidia CEO Jensen Huang calling on lawmakers to ease chip curbs. We'll bring you those details next. And Lowe's results coming in at better than forecast amid signs of a resilient consumer. All that and more ahead on Morning Brief.
Now time for some of today's trending tickers. We're watching Nvidia, VF Corp, and Lowe's. First up, Nvidia CEO Jensen Huang called U.S. chip export curbs a failure. Speaking at a conference in Taiwan, Huang said Nvidia's market share in China has decreased from 95% to just 50% in the past 5 years. Huang also praised DeepSeek, which built its AI model on Nvidia chips, calling it a gift to the world here. Well, shares of Nvidia right now, they are down by about 1% here coming into the start of today's activity. And it wasn't a gift to shareholders, we do know, in the immediate reaction that we saw for Nvidia shares after the DeepSeek announcements took place. But then it really was a changing around of the narrative as to how they are embracing more competition, which is going to come in the form of language learning models, more chip manufacturers, and that market share is perhaps going to continue to shrink, or at least some of the chips will fall off their table onto other manufacturers.
And this was the key question when the United States announced an easing of chip restrictions with the Saudis. The idea being, can that outweigh any weakness to come if Chinese buyers are locked out of the market? Nvidia CEO Jensen Huang throwing cold water on that idea, saying directly that this furthers Huawei instead of hindering that company and puts China in the front seat when it comes to winning on AI here. The company also saying that China alone will account for a $50 billion opportunity by 2026. If American tech companies like Nvidia aren't allowed in, local customers will spend that money elsewhere, and that could be a benefit to those Chinese tech companies that these chip curbs aim at curbing. Well, next up, shares of apparel and shoemaker VF Corp falling over 10% after forecasting a larger than expected loss in the current quarter of $125 million. The parent company of Vans and Timberland saying it is rushing products to the U.S. before the 90-day pause on country-specific tariffs expires. It also plans to raise prices on merchandise due to tariffs. The stock down 16%. This isn't the first time over the past few years we've heard about weakness with Vans, VF Corp, I should say. And I recently took a look at the cost of Vans online. It's a really affordable shoe. So I'm not surprised to hear them talking about raising prices. The question is the consumer demand already in question? And then what is a higher price shoe going to do to that demand?
Yeah, absolutely. And this is not the first that we've heard from at least one of the footwear companies, Under Armour, signaling something similar, trying to figure out exactly how much of that cost, and this is going to be the major calculus that all of these brands have to run. How much of that cost do they ultimately have to pass on to consumers, and for how long a period of time until they actually start to see that show up in their overall wholesale orders that are being bought by their retail partners, as well as what they're able to sell through on the inventory side. So if we started to see inventory pile up, that is perhaps as clear an indicator as you can get that consumers are pushing back on price, in addition to the fact that there's still going to be future seasons that they have to try and design and forecast and ultimately run their own modeling around how much of that inventory in the future they'll be able to sell through to, as we're seeing kind of a pullback from much of the direct-to-consumer emphasis that a lot of manufacturers had put on themselves, and now trying to, re-engage with many of those retail partnerships. Nike, one of those main players, but VF Corp also has a large retail and wholesale distributor outsized proportion of their sales to be considered within this as well going forward. But shares right now taking a hit, down 17%. Finally here, shares of Lowe's. This one is one of our top trending tickers this morning, rising this morning after reporting earnings for the first quarter that beat the street's expectations. That's despite a decline in same-store sales and a larger exposure to the DIY consumer than its rival Home Depot, which confirmed in its earnings call that it's not going to raise prices due to tariffs. Shares right now of Lowe's, they are seeing a little bit of a move higher, up by about 0.4%. They did reiterate, I believe, is what we saw within their forecast as well. They did reiterate their full year expectations, and that is something that did catch the attention of the street here as well.
Yeah, basically better than the worst feared result when it comes to Lowe's here. And we're getting some headlines in from the CEO. Speaking on the earnings call here, Marvin Ellison talking about efforts to speed up supply chain diversification. As you know, Brad, this is something we also heard about from Home Depot, who said they'd get no more than 10% of their supplies from each country, which I think is a really telling stat, that these companies just don't know which countries they can trust amid this pending trade war and all of the uncertainty that holds. Well, you can scan the QR code below to track the best and worst performing stocks at the Yahoo Finance's trending tickers page.
We've got all your markets action ahead. Stay tuned. You're watching Morning Brief. Just seconds away from the opening bell on Wall Street and in Midtown Manhattan, Times Square at the NASDAQ. There you're taking a look at USA Sail Grand Prix team. They're about to ring that opening bell at the NYSC there. I've never done any sailing in my life. I've only listened to Sailing by Seal, but all the same, good luck to them. Patriots also ringing the opening bell. Patriots and National Bank ringing the opening bell at the NASDAQ. Yeah, press that button, get yourself some funfetti as a reward here. All right, we've kicked off today's trading activity here. Goodbye futures, hello real-time cash trading. So let's get to the Dow Jones Industrial Average. We are down by about 0.9% to start off today's trading activity here. We've got a few of those retailers that we've been breaking down for you throughout the morning, reporting results here. Notably here, Lowe's and Target catching a lot of investor attention here. We'll see exactly how they open up in a hot second. S&P 500, you're seeing that move lower by about 0.6%, so fractional decline there. And as well for the NASDAQ composite, you're seeing some fractional slippage there to begin today's trading activity. Want to take a look at the 11 S&P 500 sectors. We've got them fired up here for you on the screen, and yikes, nobody's really fired up here. In fact, we're all just kind of on fire, ablaze right now, if you will. Red across the board as you've got consumer discretionary pulling up the caboose here. That's down by about 0.9% here. All 11 S&P 500 sectors in negative territory. Let's take a look at the tech-heavy NASDAQ. And this is the NASDAQ 100 here. We couldn't quite frame out 3,000 companies plus to put on this screen for you. So we filtered it down to the NASDAQ 100 for you. You've got a lot of red here too. And let's focus in on some of the biggest movers and laggards. As of right now, a company that did report earnings, one of the top trending tickers on the Yahoo Finance platform as well, Palo Alto Networks. You're seeing those shares moving lower to start off the day by about 6% here. However, you are seeing AstraZeneca actually catch a little bit of a bid to start off today's trading activity. Let's see if I can pull that one up. Yes, we can indeed. Yes, we did. And yes, it's up by about 1.4%. But as you can see, Sea of Red, Take-Two Interactive. It takes two to make a thing go right, but it's not going right today. It's down by about 3% to start off today's trading activity. Here's a look at the Dow 30 as well to begin today's trade. And still, a lot of the same, much red to be found. Home Depot, though, that is catching a little bit of a bid here. That's up by about 0.25%. Also seeing Coca-Cola, KO is the ticker symbol there. That's up by about 0.3%. Those are really the only two movers to the upside here to begin today's trading activity of the Dow 30 components. And with that, let me toss it on back over to Maddie for today's strategy session.
That's right, Brett. Thank you so much. It is time now for today's strategy session. U.S. stocks opening in the red after snapping 6 days of gains. We got rising bond yields sparked by deficit concerns weighing on risk sentiment. So, are investors still too complacent amid the recent market calm? Joining us now on this, we've got Stephen Dover, Franklin Templeton Chief Market Strategist, along with Travis Prentice, CIO of the Informed Momentum Company. Thank you both so much for being here this morning. Stephen, I want to start off the conversation with you because we are seeing a little bit of so-called market complacency according to our sources here. What should investors do to hedge against that uncertainty? Where do you see continued opportunity?
We primarily are focusing on the broadening of the market. We had a very concentrated market the last few years. That's broadened out even year to date, and we see a further broadening. And to push that a little further, we would advise investors to go abroad. We see a lot more opportunity overseas versus the U.S. than we have over the last certainly 4 or 5 or even 10 years.
And so with that in mind, as you're thinking about this strategy and how that kind of sets up for where investors should be kind of placing their portfolio and weighing their portfolio, I mean, where are you kind of looking at this activity and initiating any type of trade today on this?
So it's interesting. We just had our CIOs meet, and we said something that probably you don't really like necessarily to hear on the news because it's not aggressive, but we did call it aggressively neutral. That right now we think the market's going to be pretty much sideways for the rest of the year. So it's an opportunity to upgrade in quality and broaden and probably look at where you're pretty far from the benchmark or pretty far from neutral and think about whether you want to move in that area. Most U.S. investors and indeed many foreign investors are actually underweight overseas. They're underweight and more broadly diversified, and that's where we look specifically in terms of sectors, maybe a barbell type of approach where you're looking at growth, which would be the big tech firms, and then you're also looking at quality, particularly quality dividends. And then just lastly, what to avoid. You probably want to really look at avoiding perhaps energy as prices drop. And you're going to have to be careful with industrials and consumer discretionary as the tariffs roll in. I think specific companies could do well, but as groups, they're probably going to be challenged.
And Stephen, I want to bring you into the conversation because one thing that I've been thinking about here is Travis. I'm so sorry. I want to bring you into the conversation because I know that you sent over some thoughts about international plays as well. And it was interesting. You mentioned France, Canada, China, Europe overall, Europe financials, a lot of different opportunity, and only 1 or 2 things related specifically to the U.S. Is that a signal of what you're hearing from clients right now about demand for those international opportunities?
Yeah, well, I think our clients, to echo what Steve said a little bit, is to stay diversified in this kind of tumultuous market environment. And so I certainly part of that is diversified by styles, but also diversified by geographic exposure. So, we don't think it's an either or, U.S. or non-U.S. We think it's all of the above. And specifically having a style of investing like momentum that picks up on trends kind of no matter where they emanate. I think if you look at the world stock by stock, opportunity by opportunity, it is a world of opportunity. And certainly we see some very strong trends as you laid out in Europe, even Chinese biotech. We're seeing some emergence of Chinese biotech companies with some of the deals that we've seen lately. So there is tremendous opportunity even in these dislocated market environments.
You know, further to that end, Travis, you hear all these deals that were talked about on the president's international trip, the CEOs that went along with him. What type of kind of overall kind of assessment did you have when you were looking across the international opportunity for now some of the very U.S.-centric companies that are trying to do business in other parts of the world and the exposure that they're trying to add on to diversify their business revenue sources?
Yeah, well, when it comes to politics and macroeconomic forecasting, I mean, we always think about Yogi Berra's quote, predictions are tough to make, especially if they're about the future. So we don't really pay attention to the noise and the headlines. I mean, we look at stock specific medium term trends and try to lower the signal to noise ratio and really focus on objective measures of strength. But I think when you do that, I think one of the things that we've seen in this market environment, even in the volatility that we've seen, where the buy the dip mentality is definitely still there. And beta is all that really mattered in the sell-off and then in the subsequent rebound. But through all the noise, there are some pretty strong signals. And you mentioned some of the deals overseas. And one of the emerging trends that we're seeing reassert itself is the AI industrial trade, which, you know, obviously that trip was part of, but also aerospace and defense. We've seen very strong European aerospace and defense opportunities, but now you see in the U.S., some of those trends really reemerging and asserting themselves as far as aerospace and defense. I mean, we saw Boeing hit a new 52-week high actually the other day on some of those announcements.
You know, just last question to you, Stephen. What does it mean when we have this much of the retail trader environment and cohort that is supporting so much of the rally back to these levels?
Well, that's never ultimately a good sign. I think that there's retail is a little bit fickle. We think that there's a real shift here in terms of what we're going to see in the next 5 years. The U.S. has had the tailwind of fiscal stimulus the last 5 years. This tax bill, while somewhat stimulative, is really just a continuation, if you will, of tax rates we already have. Whereas we have a lot of stimulus coming out of China and Europe, and that's why we want to broaden the market and see other opportunities. And I think that's probably where retail as well as institutional investors are going to go over the remainder of this year.
Stephen, Travis, thanks so much for taking the time just after the opening bell. We appreciate it.
Thank you.
Let's get to the three market movers that you need to watch at the open here. Yahoo Finance's Jared Blickery has more. Hey, Jared.
Thank you, Brad. We're going to do something a little bit differently today. We have markets, some that are at record highs and some that are approaching there, and yet we got some warnings in the bond market. So let me just go over what's happening in the iShares MSCI All Country World Index Fund first. And if we dial up the Wi-Fi Interactive, you're going to see this is a year to date. Only yesterday did it hit its first record high post-liberation date, and those highs were back in February around the same time that U.S. stocks were peaking as well. Now, this is heavily weighted to the U.S., but as a prior guest we're just talking about, we've seen a surge around the world thanks to a lot of fiscal stimulus. And here's the industrial sector in the U.S. Large cap industrials hit a record high only Monday. They were the first sector to hit a record post-liberation day. And then I also want to show you what's happening in one of their sub-industries, like a subsector, aerospace and defense. And prior guest was also talking about that. You can see it has been hitting record highs for close to the last 2 to 3 weeks, and that's ITA right there. It was hitting a record high only yesterday afternoon, and it was very close today. So you put it all together, here's the S&P 500, not quite at its records. NASDAQ 100, we're quite there, but we just need that one more catalyst to get over. Yet, here's my second point. We have these warning signs in the bond market. This is a year to date in the 30-year Treasury rate, and we can see it is now up 5.03%. That is the highest that we've seen in a number of years. And on an intraday basis, you know, we've seen it claw back those. We've seen it decline like we did on Monday. But when stocks opened Monday, guess what? Tech was the hardest hit. And I think it's no coincidence that we've also seen a weaker dollar. People are selling dollars to sell their treasuries, and they're just getting out of the U.S. And that's not necessarily a good thing. And so I'll show you what's happened in the sector action this week. Here's today. This is tech right there. there, XLK kind of jumping around down 0.7%. XLY is almost like tech. It has Amazon in there as well. And here's a 3-day look, and you can see tech right there down by the bottom. This is what you expect when you see 5% yields and those surging above. And so we don't want that to continue. Moving on, though, we do have some safety trades and maybe a risk-on trade if we take a look at gold futures. So that's physical gold and also digital gold in a second. This is a year-to-date, and as I've been talking about for the last week or so, we came down. We had a breakdown, but it looks like a false breakdown. So we're just back into this consolidation zone that we've seen over the last month and waiting for that next catalyst. Gold futures having their best week in 6 weeks. Silver futures just had their best day in 3 weeks. And then finally, Bitcoin. Want to linger there for a second. Really have to admire this cup and tiny handle right there. Seems like it wants to break out. I'll show you the 2-day price action so you can see just kissed 108,000, ever so close to that high, but it's gathering strength. I think if Bitcoin can break out, might be able to drag equities with it, but it all gets back to the bond market. If we see too much strength in yields, that's just going to weigh on everything else, especially the tech sector. Back to you, Maddie.
Jared, thank you as always. Coming up, we're going to break down the latest on the tax cut debate in Washington and where lawmakers landed on that SALT cap deduction. More details on that to come after the break. What is the SALT deduction cap and why is it such a sticking point for the Republican Party in its tax bill? To understand why GOP lawmakers are clashing over the cap, let's take a step back and look at what the SALT deduction is. SALT stands for state and local taxes. When people pay taxes to their city or state, they can subtract those payments from their federal taxes. This is called a tax deduction. It lowers the amount of income the federal government can tax you on. But in 2017, the Tax Cuts and Jobs Act capped the SALT deduction at $10,000 per household. Prior to that, there was no limit on how much you could deduct. And this change hit hard for people in high tax states like New York or California, and for homeowners who also pay high property taxes. They couldn't deduct as much, which meant they owed more in federal taxes. The 2017 SALT cap is set to expire this year unless Congress takes action. And that brings us to the Republican tax bill. Speaker Mike Johnson says Republicans came to an agreement with holdouts from higher tax states to raise the cap to $40,000. The agreement comes just one day after the president urging House Republicans to pass the tax bill in a visit over to Capitol Hill.
A sell-off in bonds is pushing the U.S. 30-year Treasury yield near 5% amid concerns about the U.S. fiscal outlook. President Trump is cranking up the pressure on divided House Republicans to pass a tax bill that would add roughly $3.8 trillion to the national debt, according to an analysis released Tuesday by the Congressional Budget Office. Heather Boucher, who served on President Joe Biden's Council of Economic Advisors, joins us now. Heather, good to have you here with us. Just take us into your own analysis that you've been able to run on what has been talked about in everything from budget reconciliation from this administration to big, beautiful bill, and how all of these things would play out over the longer run.
Well, listen, this is not a great bill for the long run for the U.S. economy, let alone the short run. I mean, here's the basic facts about it. This is a massive tax cut for those at the very top of the income distribution, while not giving a lot to those at the bottom, and in fact taking from them in terms of severe cutbacks to health insurance, access to health insurance, and nutritional support for low-income families. This is going to lead to higher costs for families across the income spectrum. That's going to particularly hard hit lower income families, and all of this so that billionaires can get a tax cut. At a moment when I think all of America is scratching their head and saying, why? Why do the richest people need all of this money and starving our communities of the things that they need to thrive, both as communities, but also in terms of their local economies? You know, making energy more expensive, making healthcare more expensive, making it harder to access food. None of this is going to lead to stronger local economic development. In fact, it's going to make everything just that much more challenging. And let me note one more thing that I think is getting lost in the details. That, you know, so this is a massive tax cut for those at the top. It's going to have repercussions for states who who are now going to be left holding the bag for many of these costs. When folks get kicked off Medicaid, when they don't have enough to eat, state governments and localities are going to also have to step up. So all those other things that states are spending on now, like education, are going to get hard hit by these cuts. So we're starving our future, literally, and none of that is going to lead to the kind of strong and sustainable economic growth that Americans really deserve and want to see.
Heather, it's a reminder of the importance of local elections. If you're in New York City, that mayoral race coming up here, but I want to stick to federal. The president had something interesting to say with regards to federal spending this week. Let's take a listen.
I'm a fiscal hawk. I'm a bigger fiscal hawk. There's nobody like me as a fiscal hawk.
Massey said it has more deficit than Biden did, and this bill kind of...
Because we have to fix the country.
Heather, help me square this with what you are saying. You are talking to me about the amount of spending happening in this bill. The president says he's a fiscal hawk. Which is it?
I am sorry, Mads. That is literally laughable. This piece of legislation is the opposite of a fiscal hawk. We are going to spend trillions of dollars on tax cuts at the top that's going to add to our deficit. The congressional budget estimates that this could be around $4 trillion of increased deficit spending. That is not fiscal hawkery in any way, shape, or form. And all for what? It is not for investing in things that matter. It's not for investing in ways that are going to benefit our economy. It's just a massive giveaway to the top. So the idea that he would call himself a fiscal hawk is I mean, again, quite frankly, it's laughable, but it's disturbing when you combine that with the other things that the president has said. He doesn't care if there's a recession. We'll get through it. But he's going to be starving the government of the capacity to help us weather a future recession. He doesn't care whether or not kids have access to toys next Christmas. Children don't deserve a lot of dolls. I mean, this is all a real sense, a lack of a sense of caring about the economic circumstances of millions of American families.
Heather, though, I am hearing from, and I talked to a lot of my sources on Wall Street that are bullish about these tax cuts, about a refueling of consumer spending, that it's going to delete the hit from tariff policy. Is there any chance that there's a growth narrative to come from this tax bill that we're ignoring in the conversation right now?
Well, I mean, let's take this with a grain of salt. Many of those folks on Wall Street will directly be beneficiaries. Their incomes will go up, so maybe that will affect their spending. Certainly, they will be able to afford more. But in terms of consumers around the country, in terms of low and moderate income families in rural parts of the country and in places that are not on Wall Street, they're going to be strapped for money. They're going to receive fewer benefits. They are not going to be receiving big tax cuts, and things are going to be more expensive for them. Everything from how much they have to spend on healthcare, because again, state governments are going to be starved. They're not going to be able to spend as much, to how much they have to spend on education, how much they have to spend on energy, on top of the goods that will be more expensive because of the tariffs. So this is really, this might be good, again, for some folks at the top of the income spectrum, and that's, that's the reality of the situation, but this isn't good for America.
Heather, just while we have you, the 30-year, especially as we're continuing to watch the bond market on the side of our screen here, our viewers, where the bond market sell off after the Moody's downgrade and that going to AA from AAA, that had an impact on the bond market. And as we're thinking about what that carries through to housing affordability, what is your assessment for the long term and the prospect for us to get out of an affordability crisis that we've already been in?
Listen, there is not good news here, and that is why we've seen consumer sentiment drop for many months in a row. People are very worried. Interest rates go up. That's going to make it harder for families to afford a home. The Federal Reserve is concerned that we're going to see stagflation, that it will be the combination of higher costs for families on top of higher unemployment, that might be in our future. None of this will make it easier for families to afford a home, let alone other big ticket items. And all of that in a consumer-driven economy is going to create challenges. And again, none of this is going to create the kinds of good jobs that people need to see in their communities that can then drive that consumer spending, that can drive that economic security that families need and want. The The federal government has taken a chainsaw to all of the other things that could have made investment that much more profitable for communities around the country. So the long-term forecast doesn't look good. It's looking increasingly uncertain, in terms of how this plays out. But I will say, part of my uncertainty is Congress has the ability to reverse course. Yeah. They have the ability to not pass this legislation, and that would be really good for the economy. And I think that's what the bond market is saying right now. Whoa, let's not go down this path.
Heather, good to see you this morning. Thanks so much for taking some time.
Thank you.
We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. We're tracking moves in commodities in oil and gold this morning. Here with more, we've got Yahoo Finance senior markets reporter Inez Ferre. Hey, Inez.
Hey, Brad, and a report that Israel could strike against Iran's nuclear facilities is what has sent oil prices higher. We have seen a little bit of a seesaw with these prices that are off their session highs, but you've got WTI up 0.8% and Brent crude also up less than 0.5%. I'm going to pull up a 1-month chart here because you'll recall that oil was under pressure recently because it seemed the U.S. was nearing a nuclear deal with Tehran. Now, that deal seems to be far from happening. Iran is the third largest producer among the OPEC members, so it's a very important producer. It also exports about 1.5 million barrels of crude per day. There are some counterforces that have been happening here when it comes to crude prices. That's why we've seen today's move that hasn't been as pronounced as imagined. Those pressures include more production from Kazakhstan, also Norway, also increasing inventories, U.S. inventories, and OPEC's increasing output. Also want to mention that the U.S. dollar is down, and that has also been sending oil prices higher as well, and also gold prices. So you'll see that gold is up to around $3,300 per ounce. You had seen a little bit of gold prices going down when we saw the overall markets going higher because of the tariff relief rally that we saw recently. But now we are seeing investors going towards a safe haven once again, guys.
All right, Inez, thank you so much. More ahead on Yahoo Finance.